Hey traders, this is Blake Morrow with Trader Summit. It's Friday and I have Mr. Jim Welsh of Macro Tides. He's joining us as he always does. And all of you should be thinking, man, I really appreciate what Jim does every Friday. Give him a big thumbs up. Subscribe to the channel so you don't miss this exclusive content. Jim, how are you? Good to see you. Happy Friday.
I'm doing good. Hey, man, it's Friday.
It's
And I
Friday.
get to talk to Blake.
Yeah, okay, before we get too like uppity about everything, let's talk about non-farm payrolls. Is
Yeah.
it jobs number, good jobs, good headline number, but there's some things underneath the surface that are a little concerning. But I know you have some comments about the jobs report. So how do you see it and how do you read it?
Okay. If you just take it in by itself, it was a decent jobs number. If you add the last couple months, the clip is still over 200,000. Wages grew, but not as much. Hours worked, which is important, rebounded. And, when we talked about the January employment report, I noted that there was an extreme cold spell in January, where it got down to freezing in Florida and Texas. And it happened during the week they were, collecting the data for the January jobs report. So I think what we've seen is you had just some volatility in the numbers, and that's always the case. I mean, people say, well, what do you think the job numbers can do? To me, that's a fool's errand because you got 155 million jobs out there. 0.1% is 155,000.
Yeah.
So, to me, it's kind of like a stupid sport. Let me try to guess the jobs number. To me, the trends are what matter more. And again, we're seeing over the last 18 months, the trend of job growth is slowing. Is that trend going to change? I don't think so.
All right. Well, in the jobs report, let's talk about some of the things that do matter, like wages. I mean, how did you read that data that came out?
It's constructive in the sense that the acceleration in January wasn't maintained, but at the end of the day, average hourly earnings are growing comfortably above the level that they were growing before the pandemic, and to be copacetic with the idea that inflation will continue to work its way down. So Powell has been saying for some time that they want to be patient, they want more data, and I think that's one of the aspects is that it's going to take time for wage growth to continue to work its way down. The unemployment rate ticked up. And again, I have been saying, and in the last report I put out, if you look at, and I didn't have that chart with, maybe I did, I can't remember. Anyway, WARN notices, which is basically companies having to provide 60-day notice.
Yeah, and you have been mentioning
we
this.
did
The
cover
last
that,
couple
I think, a
weeks.
couple weeks ago.
Yeah.
And so, that is for warning that we're going to see job growth slow, and that kind of stuff is coming. So I think the jump to 3.9 might be too much for 1 month. But my take has been as we get closer to mid-year, I believe we're going to see the unemployment rate tick higher.
So, Jim, let's talk a little bit about the price action, because at first people go, oh, the headline number was strong. Some of the wage data was a little weak and whatnot. The markets, just turned off and just took off to new all-time highs. Now, we've given back some of those gains. We're almost back to where we were. We're pretty much back to where we are just looking right when the data came out. What's your reaction to instant price action here?
Yeah. Well, I think there's one of the slides we're going to go through, charts, is looking at semiconductors. If you want to know the pulse of this market, you must look at Nvidia, super microcomputer, and SMH, because that's what's been pulling the market up. So, one of the things we've talked about is how the tail sometimes wags the dog in terms of options trading having an impact. So there's options on individual stocks. Well, the semiconductor stocks, the options on those stocks is comprising 43% of all the stock options that are being traded. Also, if you look at this, the semiconductors versus the S&P, they are now, if you will, above, more expensive than they were back in 2001 and 2000.
That's wild.
So this is just, again, there's a lot of speculation. You have a terrific narrative, narrative, in terms of AI is going to save the world effectively. And these companies that are great companies have enormous backlogs of demand. And, it's a great story. And so right now, momentum is also a big factor in the market. And so you bring it all together and you have people, trading options, which the dealers who sell those options then have to do hedging techniques. At the end of the day, it all adds up to more demand for those particular stocks. So just, again, to me, these are warning signs. But, people can stay crazy for a while,
Right.
until the spell breaks. Now, one thing I'll note is Nvidia has the potential of recording a key reversal day. It made a higher high relative to yesterday by a fair amount, and it took out yesterday's low. And just before we started talking, Nvidia was down on the day. The semiconductor index, SMH, same pattern, higher high, lower low, and last I looked, it was down. So that's the kind of thing that has a tendency of happening when you go through this kind of a parabolic, where it seems like the demand is insatiable, and then all of a sudden there isn't anybody else really yet to buy at that price level, and it's a trigger for people to start taking money off the table. So today could be kind of an important day in terms of looking at Nvidia, Supermicro, and the SMH, because I think that those stocks and that sector is the key to the market.
All right. Well, I kind of skipped over the first chart that you brought. We kind of just jumped into the semis.
Yeah.
But the first chart you brought was the S&P. So let's discuss it a little bit here. I mean, obviously, it's interesting. I have a channel that's kind of similar to what you're looking at here, but it doesn't matter. The way you look at it or I look at it, the trend is higher. And I don't think we can really argue that the trend isn't
higher highs,
higher highs,
higher lows.
Right.
Okay. So in Monday's weekly technical review, I said the 5,050 level was important, and that a close below 5,050 would be the first sign that we're seeing some kind of a short-term top.
It's interesting. I called that the line in the sand this week too. Yeah.
Okay. Yeah. And so what happened? The S&P traded down to 5,057, and then has obviously continued to rebound. Right. So to me, that line is a more important line, and it truly merits the line in the sand, because now we have two prior lows that are kind of congregated right next to each other within a handful of points of each other. And if and when the S&P closes below 5,050, I think it has more significance, because it's not just taking out one prior low, but two prior lows. Great and point.
Make it simple. Make it simple, right?
That's it. I mean, and do I think that's going to happen? Yes. Is it going to happen next week? I don't know. We're in the middle of somewhat manic behavior, and trying to time the end of that I can't do it. But what I do know is, historically, when that reversal comes after manic behavior, there's usually a pretty quick, sharp decline that follows. And then there'll be a rebound bounce. And if that rebound bounce hits a lower high, then you take out, the initial low, well, then that's how you build a top. And we're not there yet. And the first stage would be taking out 5,050, and then we'll see where does it find support? Is it 49.50? But first things first.
Right.
Let's see how today finishes, in terms of those key stocks and sector, if they do record a key reversal day, to me, that's like, okay, the probabilities have just increased that this sector is making at least a short-term high.
Great points. And so, yeah, without putting the cart in front of the horse, let's just, first things first, as you pointed out.
Yeah, it's show us.
Yeah, exactly. Prove it. See the whites of
One
their
last thing, a few weeks ago, I talked about 52.19.
Yeah.
Being a potential target.
And actually last week, I think the headline was 5,200.
Yeah, but I mean, verbally, we had kind of talked about it. I had shown it in charts and stuff. And so today we got, I think it was what, 51.89, 87. So, now you're within 30 points of it. So, it's like horseshoes. You get close enough, you at least get a point, So that's why, to me, as we're coming together in terms of what's happening with Nvidia, Supermicro, the SMH, the S&P getting very close to this target, it's time to be, I think, a little bit more cautious. But you have to, we'll see how today finishes.
Horseshoes and hand grenades, Jim. Technical analysis. It's all the same. All right. This chart here, you have the Longview. So explain to us what this is, Longview.
Okay. Longview Economics is a research outfit. Okay. I see their stuff periodically. I've always thought with some respect, which is why I thought, okay, this is worth showing to you and everyone else. And this is a measure of how expensive equities are relative to the bond market. And this goes back to 1965. And there's only been 3 times where it got this extreme. Now, 1983 was an interesting time because the economy was just accelerating out of the most expensive, the deepest recession since the 1930s. The PE ratio in 1982 of the stock, the S&P, was under 8. Now we're at 21. All right. So the other time was 2001. So again, this is just a risk parameter. It doesn't give us any timing like, okay, now that this is here. No, it doesn't work like that. And I also included where it gave strong buys, and you can kind of see, and this is a log chart of the S&P, but those strong buys were great signals. So to me, that adds credibility. It's like, oh, they got a strong sell. All right. But when did they ever say buy? And that's why I think these guys do good work. It's worth paying attention to. It doesn't give us anything about, is it going to happen in the next week or 2 weeks? But it does tell us that risk reward is getting significantly shifted to the point of a lot less upside and potential downside. So
that it's worth noting for sure. All right, so let's talk about. Let me move along here, and I appreciate you bringing that up. Nvidia. So tell us a little bit about this chart. Let me find it. There we go.
Yeah. I mean, these are the 2 stocks, the darlings of AI.
Yes.
And again, good companies, well managed. They're making a lot of money. And so, as I noted last week, to compare what's happening with these companies with the dot-com bubble, you just can't do it, because in the dot-com bubble, there were a lot of flaky companies that didn't survive, and those can't be described. Are things getting a little ahead of the reality? I think so. These stocks are obviously doing a parabolic rise, and I did these charts before the reversal. So when I say a key reversal, what you can see is Nvidia made that high, and then it took out yesterday's low. I don't know where it's trading right now, Blake. And the same, Supermicro hadn't done it quite yet. So again, to me, if you want to know what's going on in this market and identifying a high, even just a short-term high, I think you got to pay attention to these 2 stocks because they're setting the tone.
Right.
So for people that are trading options, not just in these stocks, but the overall market averages, How are those stocks doing? Okay, we're still green light.
Right.
So that's why, to me, these two
So
stocks need to be paid attention to if you're tracking the market.
sentiment shifts here, then sentiment may shift everywhere else.
Just short, yeah,
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 short term wise. Okay. Well,
yep,
Treasuries, what are you making of yields? Because yields, they've come off quite aggressively here. So what do you think?
yeah. Well, okay, you got 5 down from the high last October. All right. So to me, the longer term trend is for yields to work their way down. In late December, the expectation was that we were going to see yields tick higher. A couple of weeks ago, I noted, hey, they've completed the minimum in terms of that A, B down, C up. But this trend line obviously was important because the 30-year stopped basically slightly above it. And it raises the potential, Blake, I think, that you could see the B portion of this big thing. So the 5 down was wave A, retracement tick higher for yields is a wave B. And then I think we're going to see another 5 wave decline to bring yields down below where they were at the end of December. That B wave can either be an ABC or it can be a triangle, A, B, C, D, E. So that trend line to me is important. As long as yields hold above and it doesn't close below, I believe it was 419, the intraday low, it opens the door that we could see yields tick above the 4.5 mark before the correction is complete, and then looking for a big decline.
Okay. And to clarify here, you've been looking for a dollar sell-off, and we've got it now, or it's at least it looks like it's starting pretty well. So we got this dollar sell-off, but you were really looking for weak data to do this. We really got more of like, I want to say a shift in expectations this week that has created this move. But how do you read the dollar? Because if yields bounce, you would think that the dollar might bounce too. Is that what you're seeing here?
Well, again, the RSI is pretty low, down below 30. So the dollar's had a pretty good dump. That area just above 102, I thought it could get down to 102.25. I think it was 10, it got close to that.
Yeah.
And so it's due a bounce. All right. Now, the intriguing part here is from the 105.97, you can see down, up, down to the low this morning. If you get a bounce and then you take out the low this morning, then you'll be able to count 5 down from 104.97. And that will be the signal to me that we've embarked on, it kind of confirms the outlook that I think the dollar sometime this year will drop below 100 and could approach 96 before the end of the year. So, again, the expectation was we were going to have a pullback in the dollar. That's what's happening. And I think you're right. Perceptions are counting more than the data itself. Although the ISM number was a little softer. I mean, it's, we're not seeing anything that's screaming weakness. We're just seeing a little softening, come into the mix. And again, people are front running the Fed, and I think currency traders are doing the same thing. So,
yeah. All right. Well, I'll tell you one thing that I know gold bugs are happy about is you've been looking for higher gold. I've been very what's
skeptical.
It's Friday. I've been questioning your call, and I have not believed that gold was going to break out. I thought this little false breakout was really going to just kind of hold us. But hell, I mean, I've been wrong, and it's not the very first time, nor will it be the last time that I'm wrong about something. But gold really has taken off this week.
It has. And again, part of my expectation was that about 3 weeks ago, I said gold's ready to dump, and it dropped below 2,000, and then it didn't follow through. So last week or 2 weeks ago, I was saying, hey, I thought it was going to, continue to get hit. It didn't. And that suggests to me, coupled with the anticipation that the dollar was going to weaken, that gold had a chance to pop and at least test 21.22. My expectation was that it was going to take it out. And I think, getting up near 2,200, RSI is up to almost 85. So I think if I'm right about the dollar getting a bounce, that'll be an excuse for gold to pull back. And I think we've seen 1, 2, this is wave 3 of this advance, a little pullback for 4, and then another tick higher for 5. And then I think gold will have a deeper pullback that actually could bring it all the way back down below 2100. And you might even test that area between 2060, 2080. In other words, that was the breakout. And you know how markets often do. They break out, they come back to retest, and then they take off. I think there's the potential that will happen here. So near term, I think we have a short-term high coming in, a little bit of a pullback, another push, and then I think a deeper correction. And, the dollar could play into that, Blake, in that if the dollar gets a bounce, then goes to a lower low and it completes 5 down, there's going to be a bigger bounce in the dollar after that. But these are all paths that are possible. And all I try to do is keep my eyes open to say, all right, how are these markets aligning and how are they then likely to trade off each other? And, the dollar weakened as expected, gold popped as expected. But markets don't go in straight lines.
They don't, and
unless you're Nvidia and Super Micro.
Yeah, right, exactly. Well, Jim, I'll tell you, I appreciate having you here. And that's a great thing about us being able to talk out the markets. Sometimes I feel very much in sync with you. Sometimes I don't necessarily agree, and sometimes we're right, sometimes we're wrong. It's just trying to get it right more often than wrong. I mean, that's what trading is all about, right?
They say in baseball, you got to take them one day at a time, one game at a time.
One game at a time. That's right, because it's a long damn season too.
It is.
Jim, I love what you do here, and I'm sure I could speak on behalf of all of our viewers, but if you do like what Jim does, make sure you give him a thumbs up. What's the best way to get a hold of your most recent publication?
Send me an email, jimwelshmacro@gmail.com. I did a deep dive in the March issue of Macro Tides on commercial real estate. I think later this year, and especially in 2025, that's going to be, I think, a fairly significant problem for the banking system and for the economy. So I wanted to kind of get out in front and say, okay, here's what's going on. So if you want a copy of the March Macro Tides, just send me an email, jimwelshmacro@gmail.com. I'll send it to you. I think it's worth, I guess, getting a better handle on what's going on, because Powell yesterday said it's manageable, and they're not, it's not like they're not paying attention, Blake, they are. But Bernanke in May of 2007 said that the subprime problem was going to be contained. Things change.
Yeah, and they can change rapidly, and a lot of it's kind of like everything all at once, and you're dealing with big chunks of money, big properties. It's not like an overnight fix either. So yeah, glad you did that, and I'm looking forward to reading it. I'm sure other people are too. So Jim, I want to say have a great Friday. I'll see you next Friday, and thank you so much for being with us each and every week.
Hey, love it. Thanks, Blake.
Thanks, Jim. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.